Ron Parks here and welcome back to the channel. I want to talk today about some proposed tax changes that might be coming down the road. Today we're going right into current events. There's a new president-elect, and obviously that's going to affect your taxes. You talk to people on the street and their biggest legitimate concern is what is Biden going to do about our taxes. First, I'll go over what you're paying now versus what you stand to pay in the future. Then I'll tell you the best ways to reduce that number. After dealing with the here and now, I'd like to get into something that's been recently on my mind, so we'll save the best for last. I'm no Grover Norquist when it comes to taxes. We're just citizens. We all pay our way, but how much you pay is going to depend on you. What are my thoughts on paying higher taxes? Well, I prefer not to, but I also feel it's our civic responsibility to pay our fair share of taxes. So let's start with a little background. In 2017, a new tax plan was unveiled called the Tax Cuts and Jobs Act. It's a 200-page document. I'm not going to go through everything. I'll just summarize what it did. This was essentially meant to be a massive tax cut for everyone. Every single tax bracket was lowered. The standard deduction was increased, some business expenses became entirely tax deductible, and corporate income tax was reduced from 35% to 21%. Any tax plan is bound to sour some people. There were winners and there were losers, and some people saved money and some wound up paying more than they used to. I'd like to get into some more detail about Trump's plan and how it will affect you. But the truth is, the information just really isn't out there. He is also leaving office in 50 days, so it is a moot point on anything he wants to do. Now, there are projections, but the frustrating thing about Trump is that he just hasn't released how these tax cuts will work, and those projections can be laced with political rhetoric. If you watched him on 60 Minutes, it was filled with executive orders, but no real specifics. The critical thing to know about the 2017 tax cut is that it was always meant to be temporary. Some of its provisions are already going to expire next year, and the rest will be gone by 2025. Let's talk about how it affects your paycheck every 2 weeks, the direct impact, and how it will in the next 4 years. As many of you know, a portion of your check goes to the government before it's even handed to you. Payroll taxes consist of 6.2% that goes to Social Security and 6.2% for your Social Security. That's 12.4% of what you make goes to those two taxes. There's also 2.9% that goes to Medicare taxes. And employees and employers pay only up to the first $137,700 that they earn. Under Trump, he allowed employers to let their employees earning less than $104,000 defer their 2.6% payment between September and December of this year. This essentially means you're getting a bigger paycheck, but you're going to have to pay those taxes back next year. Some small businesses have said it's just not worth the trouble. And the other issue is that Trump hasn't laid out many specifics in terms of how this works. So you're getting a slightly bigger paycheck that you're eventually going to have to pay for, and you don't know how it's affecting the rest of the country. What Biden has planned is something we've never seen before. Biden wants to take that 12.4% and redirect who it's aimed at. And he's targeted incomes over $400,000. So this truly only affects high earners, the ones that are making lots of money. Now, what will change for your income taxes? Biden also wants to direct that to the highest paying Americans too. He wants to put the top income bracket rate back to the Obama era, set at 39.6%. And under Trump, it was lowered to 37%. For now, it appears that's the only tax bracket Biden is going to change. All the others, so far at least, are going to remain the same. He would also cap the value of itemized deductions. You've seen on your tax form, you have the option of taking the standard deduction or an itemized list of things like state taxes, expenses, charities, medical bills. Usually wealthier households opt for the latter, for the itemized deductions, because they'll get more deductions. MarketWatch reported that 43% of taxpayers making between $50,000 and $100,000 a year itemized the deductions. For a family earning over $100,000, that number shoots up to 80%. So Biden would cap those deductions at 28%. He also wants to cap the capital gains tax for people making over $1 million a year by taxing it at the standard tax rates. If you don't know, a capital gain is a profit you make off an investment. So if you invest, it increases in value, and when you sell it, that's a capital gain. Right now, the capital gains tax is for people making over $400,000 a year, where you pay a flat 23.8% to the federal government. And of course, you have to pay a portion to your state. If you make less than that, it's 15.8%. So that means someone making a few $1 million a year is paying the same gains tax as someone making considerably less. Still a good chunk of money, but a lot less. Under the new plan, that's going to change for the millionaire. He's going to pay a whopping 43.4% tax rate on his capital gains. Next, Biden also wants to increase the corporate tax rate from 21% to 28%. To give you some background, before 2017, the corporate tax rate was at 35%, so it's still significantly lower. He's also calling for a maximum of a $15,000 credit for first-time home buyers. This means that it will reduce your tax bill by that amount. And if you don't make enough to pay $15,000 in taxes, they'll just give you a refund. There's also a tax credit for renters and a bigger one for children. Trump doubled the child tax credit to $2,000, and Biden wants to double it yet again to $4,000 per child. Well, how is this going to affect your retirement plans? It's all intertwined. Biden has laid out a plan for older Americans explaining what he wants to do to overall America's retirement system. That includes things like shoring up Social Security and Medicare. So those are the significant glaring changes that are going to go into effect. However, there are some other details of his plan that just haven't been spelled out yet. Suffice it to say, there's talk of proposing a flat tax deduction on 401k contributions, no matter what your federal tax rate is. But remember, many of these tax increases I've mentioned will only go forward if Democrats take control of the Senate, and that remains to be seen as of now. So those are the most significant changes coming your way, but as much as we'd like to be done with 2020, it's going to take its final piece of the pie this coming April. We've got 1 month left this year, and there are things that you still can do to offset your overall income tax bill come tax time. Some of what I'm going to go through is particular to 2020 under the Federal CARES Act that was passed this spring, but there's also some general advice sprinkled in. Here are 5 things you can do to lower your tax bill in the next month. First, be charitable. Not only can it be personally gratifying, but you also stand to deduct quite a bit. Under the CARES Act, taxpayers taking itemized deductions can deduct 100% of charitable donations this year. Again, this is something you can take advantage of this year only. Typically, you can only deduct 60% of charitable contributions. The CARES Act also offers something for those taking the standard deduction. That's $12,400 for singles and $24,800 for couples. So please be sure to keep track of your gifts and your donations. Any email confirmations that you've received about your payment, because you're going to get more back than usual, and you might need that documentation. Second, I know you know this already because I discussed it before, and it might be the perfect time to convert to a Roth IRA. Now, this is especially important to anyone who is making over $400,000, because that's where all the higher taxes under Biden are headed. If you lost any income during the pandemic, it's an especially prudent time to consider putting your retirement funds there into the Roth IRA. Remember, any withdrawals you have to make on a Roth are not taxed. And now it's a good time anytime to put money in a Roth, but it's taken on new significance with so many people struggling. Okay, number 3. Now this is for people with a side job or a side gig. I know a guy with a regular job. He writes articles about movies online. It's worked out well for him so far. But many people have turned to a second side job in terms of crisis. And it's not a bad way to do things. If you have any supplemental income, it's just essential to deduct any business expenses related to it. This can be things like your home office equipment, gas, mileage, and in my friend's case, theater tickets when he still could go. Now keep those receipts. Many people don't even consider their second job much of a job, and they neglect these deductions, and they pay more taxes where they don't have to. So anything you do related to work is deductible. So always take advantage of it where you can. Stockpile what savings you have. If you have some money left over this year, consider putting it in some healthcare savings account. Health savings accounts are paired with high deductible insurance plans, and they come with 3 tax advantages. First, the money is going to be tax deductible and it builds up tax-free. You can use it for qualified medical expenses and avoid any taxes on the withdrawal. And you can also use these funds well into retirement. And if you have been withholding or haven't made enough tax payments on that side gig, it might be wise to update your withholdings. Withholding tax means that your employer withholds from their employees' wages and pays the government directly. You can ask your Human Resources Department to increase the amount withheld for your remaining paychecks this year. And if you do have a side gig, it's important that you make estimated tax payments because your income will be up and your employer will not be deducting those because they're self-employment income. You still have time to do all these things, and it would be beneficial to get on it right away. Some of these are exclusive to 2020, and this year has been hard for everyone. So doing everything you can to reduce what you pay is just smart. And number 5, I promise I get to something that's been bugging me, and I'm going to tie it all together. We're talking about the 4% rule. Now, you may have heard of this before, and I have a video on it. It's probably been floated to you as sound advice. The 4% rule is a plan for retirement that sounds simple enough. You take all your investments in your first year of retirement and then withdraw 4% of them. The idea behind this supposed wisdom is that it's a method of withdrawing from you in retirement without depleting it too early. This may have worked back when inflation rates were different, but you can't expect to do it now and expect it to last for 30 years when interest rates are so low and you're not sure what return you're going to get in the stock market. And that's the other thing that makes this a bit of a current event. 60 Minutes just ran a piece about how more and more retirees live well past 90 and even 100. So that 30 years could also be 40 years. This is an older method, the 4%, meant for a different time. Let's take a look at the present day. Currently, the interest rates are pretty low. They're projected at 0.25% at the end of the quarter. And by the way, that projection is expected to continue for the next year. Even back in 2011, when interest rates were at 2%, how can you expect to withdraw 4% of your investments if you're only making an average of 2% a year? So what are the alternatives to the 4% rule? Well, many retirees are going to have trouble living comfortably if they're not withdrawing more than 3%. Well, you can continue to work for a few years, an option that no one looking to retire really wants, but it does seem to be happening more and more, and that makes it harder for younger generations. You can invest your savings differently, perhaps taking more risk and getting aggressive and getting a higher return. But again, highlight the word risk. In some cases, retirees live within their means for the first few years to have a better life and quality. You can say, well, withdraw 3.25% at 65 and then 4% at 80. But none of these sound that appealing. One option is a magic number. CNBC reporter Tom Anderson coined this, and it doesn't deal in percentages. With interest rates being the way they are, I don't think percentages are the way of the future. The magic number comprises what you need to retire comfortably. In other words, it's the amount of money you'd need for those 30 years. So once you figure out what it is, based upon what you're making and how much you think you'll need a year to retire, that's something to aspire to. If you're already a retiree, there has been evidence that reducing what you invest to 20 or 30% will also generate a steady, comfortable growth, which is probably the exact opposite of what you've been told. The common wisdom states that the more you invest, the more you stand to get back. But that doesn't account for the risk in the market. In the next 4 years, we don't know what will happen yet to the economy. The good news is it's unlikely to have much of an immediate impact on your retirement. But the bad news is that things aren't great right now, and it could get worse. Okay, that just about does it for me. Thanks for watching, and I hope you enjoyed yourself and learned a thing or two about the state of the union, especially on taxes. If you did enjoy it, please go ahead and smash the like button, subscribe for more, and click that notification bell to stay updated as I upload twice a week. Stay safe out there, and I'll see you next time, and thanks.